Well, welcome to MarketTamer again, and in this chart we're looking at McDonald's. One of the things I like to do certainly is, as a consumer, try and figure out how the market can pay me for things that I like. So once in a while I like to go in and get a Big Mac or fries at McDonald's, and of course it costs me money. So how can I get the market to pay me for going in and purchasing a meal that I want? Well, one way is through selling options. And so what I'm going to do here is take a quick look at this chart and see if an opportunity presents itself that might allow us to sell some options, put some money in our pockets, and ultimately get maybe a free Happy Meal out of it. So let's take a look. We can see now here this is intraday action, so we're looking at McDonald's dropping down close to the 52 area. A live quote, actually, as this is being recorded, states that McDonald's is trading around 52.25. But that's somewhat irrelevant to what we're talking about here. What we really care about is just the fact that the trend is lower, and more importantly that in the past the stock has found support somewhere around $50. In fact, in the past, if we went back to the October lows, we'd see something similar. The stock really didn't breach much below that $50 level. So that's pretty strong support. Now, when we see this action over the past few days, we need to know why the stock is moving in this way. And one of the reasons is Goldman Sachs has just come out and announced that they've taken McDonald's off their conviction buy list. In fact, the company that they've replaced McDonald's with is Brinker, and we can see Brinker here. How is it reacting today? Well, it's slightly positive. So obviously that's one of the huge influences Goldman Sachs has. It's a tremendously powerful firm in grading companies and issuing alerts such as these. It instantaneously moves the market as it has here. We're not so concerned with Brinker today. We'll just focus back on McDonald's. And one thing that's possible here is to sell a put option. Now, in general, none of us at MarketTamer.com are big fans of naked put options. Why? Because they have limited reward and quite substantial risk. Now, that's especially true with very volatile stocks where the chances of being assigned an option is pretty high if we get a move against us close to expiration. In the case of a company like McDonald's, really a different way of looking at the naked put option is a way of purchasing stock at a price below where it's currently trading. What does that mean? Well, let's say I like the fact that in the past 6 months or 8 months or so, I haven't seen McDonald's go much below $50. And right now it's above that, 52.25 or so. If I want to purchase McDonald's at 50 in the market, I can't do that. I can only buy it at 52.25. However, I can get paid at the strike 50 level to purchase McDonald's at 50. That is, if the stock comes lower and lower and lower down to 50 and breaches below it, then I can actually, I may get assigned my short put option. I may be obligated to purchase the stock at $50. If that happens, I get paid to do so. I get paid the premium on that short put option, and essentially I own my stock at a price lower than where it's trading today. So it's my way of committing to purchasing a stock at a lower price. Obviously, if the stock stays higher, I just capture the premium. The option expires worthless. But there is a lot more to this trade. It's not quite as straightforward as it might appear just from this quick explanation. There's some calculations that need to be made with respect to risk and reward. And obviously at MarketTamer.com, that's what we specialize in, focusing on risk management. So feel free to come on over there, and we'll be delighted to help you out. That's MarketTamer.com.